One, are you building a venture-backable business? Just because you want money doesn't mean you're going to get it. And even, just because you're positioned, you have a pitch deck and you think you're building the next Facebook or whatever, in reality, there's a lot of scrutiny over what you're building.
Welcome to the Millennial Investing Podcast. I'm your host, Rebecca Hotsko. And on today's episode, I'm joined by Jason Kirby. Welcome to the show.
Thanks for having me, Rebecca. I'm excited to be here.
Thanks so much for joining me today. So, we are going to be talking all about angel investing in the startup world. You have a ton of experience being a part of different successful startups, as well as being an angel investor in early tech startups. So, I'd love to start with your time working in the startup world. It's my understanding that you've experience in 4 different startups that have now been acquired and sold. So, I'm wondering, how did you get involved in these startup companies and what was your role like?
Yeah, so it started early. Kind of got the entrepreneurial bug when I was in college down at San Diego State. Kind of wanted to do more than just kind of get a regular 9 to 5 and wanted to start a business. Didn't know what I was going to start, didn't know anything about starting a business, but just kind of threw myself into it. So I started a small business in college. I was basically photography services, nothing really special. But something I was passionate about at the time. That was one piece of advice I got from successful entrepreneurs is do something that you love and the money will follow. Never chase them. And so I pursued that and ended up becoming a very successful business. Ended up expanding into different service lines, building the largest photography school in San Diego. Then I had one of the largest event and headshot services in San Diego as well. And then from there, I was learning a lot, having a ton of fun, traveling the world, traveled like 30 somewhat countries, and I was just having a really good lifestyle. But then quickly realized I was more in love with building businesses and scaling businesses than I was photography and creative aspect. And so I quickly worked towards selling those businesses. So I ended up selling those businesses and getting into the startup world. My first foray into tech startups was a total disaster. Could not raise money for the life of me and built a very fun, exciting business. I was scaling and good partners and everything, but just could not figure out how to crack the code on fundraising, especially in San Diego in 2013. Wasn't much capital to go around. But was very excited about growth and how to build businesses and how to scale businesses. So ended up having to shut down that company when an acquisition offer fell through, and then move out to New York, go to a new company. Basically, it's called LiquidSky. It's like a cloud gaming technology company, super using partners on that side in terms of technical talent. Basically knew that this was going to solve a big problem. We were allowing gamers to play any game on any device. And we went out and raised 12 million for that company, Samsung being one of our largest investors. All kinds of ups and downs that I can get into more granular detail if you so choose on what that ride involved in terms of getting term sheets, having those term sheets pulled when it comes to raising money, all the way to having an acquisition from Samsung fall through on the day of closing on something that had nothing to do with us or our business. And then eventually turning the company around and selling it to Walmart at the end of 2018, which was a massive success. And made all our investors money, made the founders money, which was a big win, and learned a ton about big company culture and how that was not the right fit for me once we got into the grasp of Walmart. Although they treated us well, it wasn't necessarily the right fit for me. Went on to another startup in kind of the gaming space, tried bringing esports into schools across the country as like a structured curriculum, getting kids out of the open toxic internet in their basements and into a classroom with adult supervision and like-minded peers to work towards the goal. Resonated well with schools across the country, grew to about 3,000 schools, 1.5 million a quarter in revenue, raised $11 million Series A. And then, they're still continuing to grow and scale. And I think they're raised a Series B and onto a Series C now. So that one's done pretty well. So that one's still in market. And then since then, I've launched Thunder and what I'm currently working on, which is a tech-enabled platform which brings me to what I'm working on now, which is Thunder. Yeah, we're a network of founders, VCs, and LPs that uses AI to identify who has a higher probability of investing into what. So founders can identify which investors are more likely to write in a check to them and investors can identify which deals are most relevant to them to spend more time on the deals that matter as opposed to getting all the noise. So we're all about signal, removing noise and focusing on signal that helps drive the list of deals getting done and helping investors find deals and access deals that they would never have found outside of their network, and vice versa for founders to access investors that they don't have access to otherwise. So that's kind of like the super long, been 15-year journey and just there, but happy to kind of unpack and any of those stories. And then of which, since acquisition of Walmart, I was also investing into startups and funds myself and kind of getting the experience deploying capital in addition to having raised capital in the venture world. So kind of seeing from both perspectives, which is ultimately why I launched Thunder, because I felt both sides were miserable in terms of efficiency and effectiveness. And so that's why I launched Thunder.
That is a very, very cool story. And when I learned about your background, I was like, this is so impressive. You got bit by the startup bug early and you've been extremely successful at it. I want to get into some of the challenges you faced during your times because you had successful exits in your startups. But yeah, what were some of those challenges you faced along the way and how did you kind of overcome them?
Well, when it comes to operating on the startup side, um, challenge that pretty much any founder deals with is like being able to run the business, grow the business, hire and manage people, and be able to do that very, very well, all while trying to smoosh and get involved with VCs and pitch them and entertain them and try to get their attention and get them interested in investing, whether it's VCs, family offices, high net worth individuals, angel investors. Um, It's incredibly difficult, and I think that's why there's so much respect for founders in America as opposed to I think in other parts of the country where entrepreneurship is not as idolized as it is in the US, because it's incredibly difficult to do everything well all the time. And often it's becoming more of a thing now, but like under health, wellness and like mental health and stuff like that is becoming more of a talking point because burnout is very common. So just kind of going back to like the Samsung stories at LiquidSky, we had raised, I think at the time, 8 or 9 million, most of which was from Samsung with the expectation that they would acquire us. We were in 6 months of due diligence, 4 to 6 months of due diligence with them to acquire the company with the intent of rolling technology across all Samsung devices across the world, which was super exciting and awesome. It was like, wow, here's this really opportunity to go from, we had about 1.5 million, point 8 user, 1.8 million users across the world as it was, but like Samsung sells billions of devices. So it was like super exciting opportunity. Um, and we have no reason to believe that this deal won't go through. Everyone's on board. Everyone's excited. We're at the point where we have bottles of champagne and like breakfast and like hors d'oeuvres and meetings scheduled all around handing out offers to everyone. And for the next day and the morning of, it's business hours in Korea, but it's like for 2 a.m. our time. And we get a text message that the, the deal is dead. We're just like, basically, there was a huge corruption case in senior management and Samsung that had recently come to light. The new CEO that came in to clean up that mess basically said every deal on the table is dead, regardless of what it is. So his signature authority went into place the day of our closing.
Gosh.
It was a crushing blow. And so it's like you just spent several months, tons of resources pushing towards this outcome of selling the company, all for it to just come crashing down. And like literally like bottles of champagne on ice, like 20 blocks from our office. We're in Manhattan. And to go to the Samsung office, we're super everyone like, well, no one knew. That was the other issue. It was just 5 of us that knew out of like a 40-person team. So no one knows that we are getting acquired, and so we can't tell it. So like that's a part of like M&A, yeah, mergers and acquisitions is typically everything's under lock. Like you can disclose terms, you can't talk about what the deal was. You can't say that it's even happening. You can't say with. And so we got approval to bring in a couple key strategic oh, part employees, but it was just basically me, the CEO, our CFO, and our board, and our head of product. I was the only people that knew about this deal. And so when me and the CEO get there and we're just like depressed, miserable, and everyone's going like, "What's going on? We had the whole day booked for something. What is it?" We're like, "We'll get back to you." Just like trying to manage a team when you can't talk to them about what actually is going on is extremely difficult. And just the mental load of like, how do we, and also you burn through a lot of your cash and not trying to raise money because you think you're going to acquire it. So we were smart enough to negotiate a breakup fee. So if they were to pull out of the deal, I think we got $1 million, $2 million from that. And then we ran out, raised some money from existing investors. We pivoted the company quickly because we were burning a lot of cash, which was sustainable for the acquisition, but not sustainable without the acquisition. So we had to quickly cut our burn dramatically. We had to remove the majority of our services for consumers because the unit economics didn't make sense at our size for consumer services. So then we had to pivot to B2B. So I was selling our technology for like basically it's considered like GPU edge compute. I won't go too much in the technology, but it was some cool, innovative stuff, especially the launch and rise of 5G wireless internet that was coming out. So we were with Verizon, LG, KT Telecom, Walmart, a bunch of other big brands that were working on some really cool big projects. So I started signing 7-figure, 6-figure contracts with these partners to basically keep us alive. Um, and with the ultimate goal of trying to sell the company to Walmart, which was kind of where we were headed. So it took about a year of that chaotic environment. We had to make layoffs. We had to the technology and refocus. It was, for lack of better words, a disaster across many different levels. But we pulled through and created a successful outcome. Walmart basically gave us, closed the acquisition in December of 2018, transitioned pretty quickly to building what was going to be Walmart Gaming, which would inevitably become Walmart Entertainment to take on Prime, Amazon Prime. But about 6 months in, 2 weeks before announcing platform, the technology, and the full integration of everything that we were doing, they changed it. And they basically just said that they want to reprioritize resources towards next day delivery and same day delivery, merging the offline and online commerce experience. And the budget they had allocated to us, which was in the 9 figures, was basically pulled away. And we were, if you've seen the TV show Silicon Valley, we were basically put up on the roof. And it was, honestly, all things, the chaos and everything aside, it was good. Very good learning experience. Walmart was, treated us very well in the circumstances that we were put in, outside of the fact that, they tore our dreams away. But, it was, I think they handled it well. We handled it well. And then, but yeah, that was probably one of the wildest, journeys I had in this world. There's many more, kind of stories, but that's probably one of the craziest that took basically a year to recover from a decision that happened just abruptly that had nothing. That was quite down the spiral.
Yeah, that is quite wild indeed. And so cool to hear about how you pivoted because that's something that I mentioned to you prior to this interview. I just read the book, The Founders, on how PayPal was created and they had to pivot a bunch of times. You just talked about how you had to pivot the company. And I'm just wondering, do you think that is a big key in success of how successful a startup will be, their ability to pivot and change their business model sometimes to be like, Kate, we have to adapt to these new circumstances. And that really drives success.
It's 100% true. And, some businesses, they can kind of hit their stride on their first, we'll call it like their first hypothesis or thesis of what they're trying to build the business around. But it really comes down to applying like the scientific method where it's like you try something, you kind of make up a hypothesis. If we provide X to these customers, we expect these results. And if you go out and try to do that and we're seeing the confirmation to your hypothesis, then you have to basically make a new hypothesis and look at the resources that you have available to be able to make that, be able to test this. And founders that I meet hundreds, if not thousands of founders on a regular basis, given my network with Thunder and all the founders that come in and tell us their stories and raise money. I see many that are kind of stuck in their ways, that are so passionate solving this one particular problem. They haven't really solved the commercialization aspect of it or have found product market fit. Maybe they have a good idea, but execution is not where it needs to be. So ability to be nimble, ability to pivot and prioritize resources was truly key to being successful in startups, in addition to a million other things of hiring great talent and knowing how to present your story and communication and building products that people actually want or need is another part. A lot of founders spend too much time building something that they want, but no one else does. It's important to kind of reflect on that and make sure you're actually building something for a market and validating that first, that the market actually wants it before you build it, is sometimes an investment well worth it before you go into a black hole, build for a very long time, spend a bunch of money, then come out and try to market it, and then it doesn't go anywhere because you didn't test them beforehand. So that's something that we had every pivot I made, we had market validation, even at the smallest capacity, it was worth making a bet on, because we had enough evidence to kind of pivot into that model. If you're interested, I can go into a similar story at Generation Esports, where pivoted in the middle of the pandemic to what became an early Generation Esports, the next company I went to after Walmart.
Yeah, I would love to hear that. And I just quickly want to ask you, because would you say that, I guess, for early stage tech startups, how can you, how can you test your market if without building the technology first? Because you mentioned that's super important, test your market, but how can you do that for tech companies?
Yeah, so it's all about like there's books called like the Lean Startup, um, building an MVP. So like this is not a one size fits all recommendation, but hopefully will spark people's perspectives on how they can approach it. So say you want to build some really cool software. Ideally, you have either the technical ability or a co-founder that has the technical ability to do so. Even if you do have the ability to build out the product in full, something that's very simple is build out a Squarespace or like basic landing page website that sells the concept of what you're building and focus on driving traffic to that with a call to action. So whether you're going to sell a new widget or a product or something that's physical or a digital good, or you're going to sell a software or a service, if you just spend a little bit of time working on the messaging and launching a web page or a landing page that sells the concept, it gets people to take an action that would look like they're going to buy, or they're going to at least submit their email. You can now gauge the overall interest. If you have less than 1% conversion rate and not a lot of engagement, you might need to tweak your messaging or tweak the offering, or maybe you just didn't strike gold. But if you have like 20% conversion rate and, a lot of people saying, where is it? I want it. I want it. What is it? If you get a lot of engagement from prospective customers that you're trying to target, that's a clear indicator that you're onto something. And then now it's worth building. So that's something I challenge people to do, whether you already have a successful product and you're trying to test a concept for that product, introducing A/B testing with just a simple MVP where minimal viable product to identify what actually resonates with the audience. And you can do A/B testing where you kind of leave the control or like, one option and then you test it against another option and you see how they perform against each other. So you can do messaging or pricing or design, all kind of different ways of testing an idea against a particular. uh, Another framework that I like to use just to kind of, before I build anything, I do something called the POST method. It's basically identifying the people, the objective, the strategy, and the tools. So you first start with people, like who are you targeting? Who's the audience? Go as far as building out customer personas. What are their needs, wants? What's their story? What's their demographics? Then you go into the objectives. What is the business objectives? So like, what are you trying to, like you want to hit money, hit revenue, you want to hit user growth, you want net promoter score, whatever your objective is for the particular task or test. Then you go to strategy. Strategy is aligning how you align the wants and needs of the customer with the wants and needs of the business. And so strategy involves, messaging, articulation of how you execute across enabling that. So the landing page that has this messaging, that has this flow. And then you get into tools. So it's like, okay, what tools will you use to enable all this? Okay, you're going to use Squarespace with MailChimp and, whatever these free kind of like inexpensive tools that kind of launch something. And the reason why I always emphasize the post method is because often people will start with tools. Oh, we need a website, or like, oh, we need an email marketing thing. It's like, well, before you go into that path, who are you targeting? What's your objectives? What's the strategy to accomplish both? And then tools, because your tools will change depending on what your strategy is. So I find that to be a very good, effective framework to kind of challenge people with, in addition to complementing that with a scientific method. Okay, you have your initial hypothesis and then test it, and, review it and basically test again, see where you're at, review the results. So hopefully
Yeah,
that answers your question.
that's a great strategy. That is very cool to hear, and one that I think applies to any business, not just a tech one. So that's very cool to hear. I'd love to hear the story, your other startup story, then I'll get into some of your angel investments.
Yeah, so another kind of having to be nimble and quickly be able to pivot. So I started with a startup in summer 2019, came in mostly as a consultant, loved the concept of what they're building, but the business was super early. They haven't had a lot of revenue, but they've definitely struck a chord with the market. I think they had product market fit, just really execution. Originally, the business was called High School Esports League. So very specific, very limited. It's hyper focused and bringing esports into high schools. It's something I was personally passionate about, knowing the gaming space, being a gamer. We had started growing. We had, started executing really well. Revenue was going up from like 100,000 to like 700,000 in the first, so 2019. So it was like, oh, big win, big jump in revenue, which is great. We had a very successful fall season. And then, come Q1 2022 or 2020, we're like, let's scale, let's get this going, let's get ready for spring, and let's raise some money. So we ended up getting a term sheet from some investors, which we got the term sheet on March 12th or 13th. Well, I think we all know history as far as how pandemic got started, but it was around March 14th that the whole world basically was like, oh, this is real. This is a problem. Shut down. And our investors basically decided to pull out the term sheet 2 days after giving it to us. So we had basically gone through this whole due diligence process, similar to what happened with that whole Samsung story. Was we prepared our business to raise this capital. We had designed everything to work in that manner. And then the rug got pulled out from under us. Oh, and our entire customer base, schools, are no longer in session. So our like entire revenue stream, our existence, everything's in jeopardy. Oh, and the whole world's on fire and we don't know what's going on. No idea what's going to happen. And the company was based in Kansas City. We had a lot of remote employees. We had a lot of people in Kansas City, but I was based here in New York. So couldn't travel there for several months. And we had to basically do this whole pivot, remote from each other, which was extremely difficult. In addition to growing the team and a variety of other things that came into play. So we quickly looked at the market opportunity and how we're going to be able to raise capital. What story do we need to tell? What milestones do we need to hit? Like kind of what's the end game that we need to accomplish from a milestone and objectives perspective. And then working backwards from there to figure out, okay, well, what do we need to do to hit that? Well, we need to go beyond just high schools. We need to service other types of clients. We need to service other businesses. So we pivoted the brand to Generation Esports, through a whole rebrand, relaunch, got a lot of positive reinforcement and positive signaling from those efforts. By no means was it a home run on our first attempt. It was a lot of, tweaking and like mistakes made along the way. I want to say that we're perfect and everything was awesome. Definitely. It was extremely stressful and excruciatingly painful to rally the team and rally our customers around what we were doing, being able to articulate it and explain it. But we started coming out on the other side with positive inputs. So we were well prepared for going into the fall, despite not knowing if our clients were some parts of the country or schools are not going back into session in fall 2020, and then some were. So it was just who knows what was going to happen. But we ended up getting revenue to I think it was about we ended 2020 with almost like 1.4 million, I think. Or like 1 point I forgot what it ultimately came down to, but grew the revenue pretty substantially despite all the chaos, and we pivoted to new business models and we got very scrappy. And then we were able to raise basically a year after getting that term sheet pulled, we were able to close a Series A for 11 million. So that was a huge home run for us to be able to pull off, and from very notable investors, which was awesome for us. So it was persistence and planning and flexibility and nimbleness is what got us out of that situation. And now they're continuing to thrive and grow. And I since left shortly after the Series A, but that was a wild ride. Us.
Yeah, you got hit by a lot of external events in your time through startups, and that's very cool to hear how you kind of managed your way through that. I am interested one last thing on your startup experience. How do you decide whether you get funding or you're trying to raise funding from an angel investor or a venture capital firm? What's kind of the goal or the difference between that?
It's a very good question. So, question you gotta ask yourself is, do you really want to raise money? So first two businesses didn't raise any money, profitable, and my lifestyle comfortably in awesome early 20s. But I wanted to do something bigger. I wanted to scale something bigger. I wanted that experience. So in order to really build something before it really makes money, you kind of need to raise. And so with that, you sacrifice control, you sacrifice uh, a little bit of autonomy. You have to focus on not just selling to customers, but also selling to investors, which in some cases is not the same pitch. And so you have to position your business. So it's a huge undertaking to raise capital. And there's all kinds of different stages of raising capital. So what our market was, so, a couple of years ago from like 2016 to 2021, it was everyone wanted to raise money and there was tons of money to go around. And that was like the big sexy thing. Oh, we raised 5 million. Oh, we raised 50 million. So a lot of founders went after raising money because why not use other people's money to build your dream as opposed to build foundational successful, building a profitable business from the foundation. So we trained a whole generation of entrepreneurs to go out and chase venture capital and angel capital without really telling them to focus on the fundamentals of building a profitable business. So there's a lot of sex appeal in venture capital right now to raise money and that kind of stuff. But now we're kind of after the recent market correction and venture capital taking a huge hit, we're seeing a lot fewer, well not fewer, but we're seeing a lot fewer deals get done, less capital get raised, more scrutiny on building profitable businesses and foundationally sound businesses that, building a house of cards, effectively, you're building actually foundational. Um, so something I always challenge founders when they're coming into Thunder, when they're trying to raise capital is like, one, are you building a venture-backable business? Just because you want money doesn't mean you're going to get it. And even, just because you're positioned, you have a pitch deck and you think you're building the next Facebook or whatever, in reality, there's a lot of scrutiny over what you're building. VCs have hundreds, if not thousands, of pitch decks to go through, and you have to be substantially differentiated in this market to even have a shot. I think it's like over 200,000 or 300,000 companies try to raise capital every year, and only 10,000 get venture funding. So it's a very small percentage get venture funding. And that's where institutional capital comes in. You're raising usually 7 figures or more. But what some people don't realize is getting some angel investors raising 250,000 to 1 million, you can raise from a bunch of small investors. You can use all kinds of tools to make that easy. You can have all these instruments like safe notes and convertible notes to make it quick and easy and low legal cost to raise a couple $100,000 to kind of get to some kind of validation, which in this market now, if you want to have any kind of business, you have to get profit or at least have a clear unit economics that show a path to profitability. And so that's like the big challenge for founders now is like, how are you going to design your business and how you can execute on your business to be lean and drive revenue sooner rather than later, which previous couple of years, it was more about like worry about revenue later, get growth and grow at all cost now. So that's like, I always challenge founders to say like, are you really building something venture backable where you're going to have to raise tens of millions of dollars and have $1 billion exit potential? Because that's all VCs want to fund. VCs don't want to fund your, small business. They want to fund venture scale opportunities where you're going to have hundreds of employees. You're going to be generating hundreds of millions of dollars in revenue. Is that the life that you want? Do you want to always be raising money and building this big team? Uh, or can you build a very successful business that does 5 a year or 10 million a year? Well, there's plenty of angel investors or small family offices that are happy to fund cash flowing businesses or have to kind of seed the start of a small business, assuming there's some kind of cash flow returns or exit potential for those investors. So it's not as difficult to raise a couple 100,000 or 1 million that will get you to that point, but just don't expect to raise tens of millions of dollars if your business only has potential to generate a couple $1 million in revenue. So it's kind of the thing I challenge people to consider and think about when whether they're considering to raise capital.
That was very helpful to hear. And I guess just before we get into the discussion of you being an angel investor on the other side of the coin, can you just explain the difference between an angel investor and a venture capitalist?
So angel investor could be someone as simple as like me, or like typically they're described as a high net worth individual, also known as by the government an accredited investor. So someone that's worth over $1 million or has an income of over $250,000 is typically labeled an angel investor if they make personal investments, usually more than like, I wouldn't consider someone like an angel investor unless they're making like a $15,000 to $25,000 investment into a company. I know there's arguments that, there's more accessibility to write $1,000 checks these days into what's known as like a single purpose vehicle or SPVs on like AngelList and these other platforms. And there's like crowdfunding sites and stuff. But what I consider a real angel investor is someone that's writing 15, 20 plus $1,000 checks. Anywhere between 25 to like $250,000 is like a typical angel investment. And that's coming from successful executives, previously successful entrepreneurs or founders. Uh, sometimes it'll be a wealthy heir to like a family, that's had a lot of money, what's known as a family office. So they're usually perceived as individuals that can make a decision independent of anyone else and can quickly and can just wire money, once they believe in you or the idea or the business. They're harder to find the right angels. It usually is a network thing. So you usually have to know someone to be able to kind of get that check. But sometimes you know someone that knows someone that knows someone, and then you kind of go through the path and you can raise that capital from them.
You made it this far into the YouTube video, so you must be enjoying our content. If that's you, you'll also enjoy our free daily email that only takes 5 minutes to read per day and keeps you updated on what's happening with your money and investments. Join over 30,000 readers now by simply clicking the link in the pop-up on this video and then entering your email. It's that simple. Just click the link in the pop-up, enter your email, and start knowing what's happening with your money.
It is hard to kind of cold email angels and get checks, but it's possible. It's happened to me. I've written a check to cold email. So that's typically what an angel is. It's an individual, and they can make a decision independent of anyone else. Venture firm is someone that there's what's known as a general partner. So this person or partners goes out and raises money from what's known as limited partners. So these are family offices, institutions, pension plans, high net worth individuals, and they'll raise 10 million, 100 million, $1 billion to then have at their disposal to invest into individual businesses following their investment thesis. So these VCs in this case are held to a much higher standard because now protecting other people's money. And as Warren Buffett says, never lose money, golden rule of investing. Unfortunately, venture capital is all about losing money. In fact, most investments are lost and to nothing, and it's what's known as like the power law effect. So an angel investor will make a decision independent of any kind of portfolio construction theory or thesis or anything like that. They're like, I think you're cool. I like you. I want to back you. I believe in you. This is a cool concept. Should exist. That's usually what indicates an investment from an angel investor. And they're usually investing an insignificant amount of their wealth, so they know it's probably not going to work out. I know most of my angel investments are probably not amount to anything. It's one of the sad realities of angel investing and why it's highly ill-advised for non-accredited investors or people that don't have the money to lose. And it's in the hopes of what's a power law effect where and this is for VCs as well. It's like, sure, like 90% of your investments are down the toilet, but it's that 1% that returns all your money and some. So if you're an angel investor, you invest $500,000 into startups, say $50,000 into 10 different startups. There might be one of those startups that go off to $1 billion valuation and you make $5 million off it. You 10x off your entire investment, where the other nine went to zero. So that's what venture capitalists are trying to do. That's what angels are trying to do. They're trying to pick winners. And ideally one of those winners goes to the moon, and they're trying to back the biggest possible companies. And that's why, back to the whole conversation earlier, is venture capital firms, they need a 20, 30, 100x return when they make an investment. And so that's why if you're trying to raise at a $5 million valuation or something like that in your early days, you need to have potential to get to a $500 million. There's all kinds of other factors in terms of dilution and other things that go into portfolio construction. I won't bore you now, but that's something that is pretty important to take into consideration. The difference between an angel investor and a VC. A VC has to be accountable to partners. They have investment committees. They have a lot more deals to look at. So they're looking at 1,000 deals a year. They're making 12 investments a year. So it's a very hard job as a venture capitalist, but also difficult for the VCs. I mean, for the founders to raise.
Mm. So you are an angel investor and you've made some investments over the years. What does your investment process look like? You kind of mentioned a few things there, but I'd love to know a little bit more about your due diligence and how you find deals to then how you figure out if you actually want to put the money towards it.
So I would say my first couple investments were not as well due diligence as I probably should have. I kind of got caught up in the hype and the FOMO that was going on in the market in 2020 and 2021. Made some bets on things that I thought could be very big, massive market potential, but also something that I felt I could add value to. So that's another thing with angels is, you know, you can kind of write a check and walk away. I've had angel investors invest in us that basically like, here's 100 grand and give me updates when you have them. And then I have other angel investors like, here's 10 grand or 25 grand, but I want to have meetings with you on a monthly basis and try to help you and advise. And they try to, advise companies and give them feedback or try to find them customers or whatever it might be. So with some startups, all that I've made investments into, typically like to have some kind of value add. So whether that's I can help them fundraising, hiring, sales, marketing, connecting them to my network, that's typically a role an angel investor will play. So if some kind of manufacturing technology company comes to me and pitches me, I'm like, I have zero value to offer you. I don't really understand the market, so I'm probably pass. Um, and then I refer those founders over to Thunder so they can send Thunder and see what they met. But with companies I do invest in, so I look at like, okay, so I know SaaS, I know consumer, I know B2B, I know crypto pretty well. Like I feel comfortable in these particular markets. So in terms of getting deal flow, there's a million ways to get deal flow. First is updating your LinkedIn, basically state that you're an investor of some, then, bunch of cold inbound stuff. There's lists and communities to join, Slack groups, and you'll just start seeing deals come. It is a full-time job, period. If you want to actively seek out investments and make investments, it could be a full-time job. And that's not something I truly wanted. So I kind of either sat back and waited for inbound deal flow to come my way or got referrals from my friends or things that I saw on like Angel List that I thought were interesting, where I came much less significant check that I didn't have as much influence on and things of that sort. So it just really depends. And it's a lot more haphazard than it should be in angel investing. There are some super angels that have very strict criteria. And then most angels, kind of like me, where it's like, I think it can have value. I think it's interesting. I know I'll probably lose my money. Those are the typical typical criteria, but I'm willing to take that risk. I'm willing to go on that journey with you, and I'll try to help you along the way. And those are typically what you want from an angel as a founder is the clear understanding that you're probably going to lose the money. That's just statistically speaking what happens, and that angel investor needs to be aware of it. And and that's why, and also for your protection, you want there to be a credit investor when you get money from angel investors. If you take a $25,000 check and it's from their life savings and they have nothing else to their name, you should not be taking their money. And as a responsible founder raising capital from other people, you should make sure to do due diligence on your investors before you take, because you don't want to take someone's life savings, promising that you'll make them there, because when that doesn't work out, which happens 90 time, that person is going to be very upset with you. And they will call you all the time. They will harass you. They will distract you. They will make your job a lot more miserable. So it's best to take money from seasoned investors that are comfortable and understand what they're getting themselves into and know how the venture world works or the startup world works, so they can add value to you as opposed to basically take value, take from you. I had this happen at another company where we had two angel investors that were just terrible. They just called us all the time. And not for like, hey, I want to help you. It was like, hey, I need you to do this, or I need a report on your latest whatever. It had nothing to do with anything that mattered to them. They just felt they had to know what was going on because they invested more than they should have into the deal. Probably should have never taken their money in the first place. So looking back, in hindsight, bad decision to have them on the table in the first place. So that's kind of my rant on angels versus VCs and raise money from.
Yeah, that's very interesting to hear you talk about that. And I love your transparency about how, I guess, unlikely it is to be successful in this, because I don't think a lot of people talk about that. And it's almost like you're looking for those lottery winners. But I guess I'm wondering, for individuals who could be interested in diversifying away from just investing in the stock market, who do you think this would be right for? Who do you think being an angel investor would be right for? Even if it's just a small part of their portfolio, maybe 10% of their total investments, do you think it would be right for some individuals?
Um, for most people, no, to be completely honest. As much as I believe in growing the market and access to capital, it's a very complicated. And I typically encourage angel investors to reconsider the idea of making individual bets and considering investing in funds, um, and funds that could get access to. So if let's just say you're a accredited investor, you're worth over $1 million, and you are comfortable making big bets with 10% of your money. There are some big bet opportunities with stocks, and that's very much picking stocks. There's a lot more liquidity, there's more options. You can get into different strategies there. But when it comes to private investments, um, there's no liquidity. You don't get that money back. You can't just be like, oh, I changed my mind. I want it back. Or can I get cashed out? You guys have a fundraise. And it's like, nope. You're in it for 7, 10, 15 years. And so it's got to be money you do not need. It's considered a savings account. They're not liquid. There's a lot of risk involved. And that's why you typically hear why it's an old boys club and venture capital is hard to break into. It's because it is. And it's probably not great for a lot of the system. But there's a lot of, I would say, companies breaking down those walls. And if someone's very adamant getting their feet wet and getting exposure to this market and making small bets, I recommend like AngelList for getting access to what's known as syndicates. So AngelList has a bunch of syndicates, and you can write a bunch of like $1,000 checks. So if you have 100 grand that you're willing to invest into the startup venture world, you can look at trying to get access to funds, which Thunder can get you access to on our platform. So we help introduce you to relevant funds that might be of interest. You join as an LP or as an angel, and you can create an account and be able to identify which VCs might be relevant to you or which companies might be relevant to you. Typically, direct investments in either to a fund or a company will usually start at around $20,000 minimum. For a fund, typically 100K plus. So you have to kind of keep that in mind. That it's not as easy to diversify a small amount. Diversification is always kind of seen as like a strategy, but it's hard to do with small amounts of money in private markets. So if you have like $1 million to deploy, then you have a lot of options. You can really architect a good portfolio strategy. But if you got 10 grand, I will say, in my opinion, stay far away from crowdfunding sites. So there's a lot of crowdfunding websites out there. They sound cool. Now, if you are a fan of a particular brand that you're a customer of, a little different. You don't necessarily want to say no to that. But typically, companies that fund crowdfunding sites are typically not well enough capitalized to have like big venture returns. Also, there's not a historical precedent on actual returned capital to investors on those platforms. Something to, well, these are the technical terms, but basically the capital that gets paid back to investors is very minimal. So if a dollar has been deployed, $1 billion has been deployed on funding, only maybe like 100 million has been returned. That's an assumption. It's not research document, but every crowdfunding platform I've partnered with or talked to, they have little to no information on what we raised 100 million, we raised $1 billion, whatever, but they don't have any stats on what actually went back to the investors. So crowdfunding is, albeit you can put $100 check in and yay, but you can diversify and you can find interesting companies, but it's hard to find the best deals on crowdfunding. So I usually like angel list if you're writing small checks. $1,000 minimum is typically the requirement, sometimes 5,000. But you can follow a bunch of syndicates. These are real VCs, exposure to great deals at negotiated valuations. Typically, crowdfunding, founder can just make a valuation and have no accountability to it. Whereas a VC will get you a better rate, better terms, have liquidity protections like what's known as like liquidity preferential treatment. So there's all kinds of protections when you work with a manager. Now you pay a fee. There's either an admin fee and a management fee or performance fee associated with that. You'll tend to get into a better deal in that situation through like an angel list syndicate or a fund than you are writing $1,000 check yourself into a company, which you will have zero say. You'll have zero influence. You'll just have to accept whatever the terms are. So that's just something to kind of keep in mind. The more money you have to deploy in the private markets, the more likely you'll be successful. The less money you have, you're writing small checks. It's one thing to maybe use it as a learning experience, maybe use it as a way to build up an education in the space, but it's an expensive education. So I just kind of tell everyone, go in there with open eyes, absorb as much information as possible, follow, thought leaders in the space, get educated. It's not like you do research on a stock. Oh, that's cool. And you go into your Robinhood account, buy 10 grand and it's 5 days later if you regret it or it didn't work out. Or like option trading, these are things that have a lot more liquidity, a lot more data, a lot more research, a lot more autonomy in those investment decisions. So that's kind of my investing in private markets, specifically startups, early stage startups, which is all most people writing smaller checks would have access to.
That was really helpful to hear your perspective on that. And I do want to ask you, though, about one of your success stories as an angel investor, because I'm assuming if you're still doing it, they haven't all been bad. So do you have one that you could share with us?
No. Too early to tell. Like I said, a 10-year game. So I have a decent amount of chunk of change spread across a couple different companies as well as a few funds. TBD. Most of that money was deployed in the last 3 years. I'll have no insight on whether everything's still alive and running. I would say some, are struggling a little bit more than others, but they're all still, they all still have a shot. But there's no like breakout, portfolio company of mine just yet. some interesting ones. I've done some cool stuff, but not like household names by any means. So it's a difficult game, and for someone that has experience, that has access, one thing I kind of decided is after I made about 6 or so individual investments, I decided to deploy the majority of my capital that I had originally intended to make individual investments in. I decided to invest into a fund that aligned with my investment thesis, and I pay the fees, I pay all that just because it's a full-time job to really do angel investing right, and that's not where I went in my head. And also, I have a slight conflict of interest making individual investments while also working with companies on Thunder and stuff like that. So it's just easier to hand that. So my personal situation is more appropriate to invest.
Right.
So
And do you think your experience working in startups and having that, I guess, that great experience building them, selling has helped you invest? I guess it's early to tell, but has that worked its way into your investment process at all or helped you, do you think?
it helps me get access. So um, founders, when I meet with them, they after having a chat with them and they learn about my experience and what I've gone through, they'll ask that I invest or be on the cap table or be an advisor because they value my input and they value my opinion. Now, they probably wouldn't want that if I was only writing a $500 check or a $1,000 check. Um, but that's typically my past historical experience is valued by the founders. I get access to their rounds, and they want me a part of their cap table or as an advisor or something along those lines, so I can share my input and help them kind of navigate certain challenges when they need me. So that's often what it's about. Is it's more about getting access and being of value, at least from my perspective, when making those investments. And so that's where my background comes into play is being able to start a conversation. So if I message a founder, I get a response. Uh, or if I didn't have the background and clout that I do, I might not get a response. Or if I reach out to a unicorn that's already worth $1 billion and I say, hey, I want to invest in you, they're not going to respond to me. But for a founder that is raising $2 million and hasn't achieved astronomical success, I would typically get a response. So that's the other thing is reaching out to founders directly and then reach out to having a conversation and figuring out what works.
Hmm. That makes sense. And two quick questions before I let you go. It kind of seems like capital dries up during hard times. And so right now, there's less liquidity to go around. Is that the same for the venture or startup world where it's harder to raise money today?
Exponentially. It was hard to raise money in 2016, 2018, 2013. Like it's historically always been hard to raise money, but we're coming out of this massive inflationary market where free capital was abundant and uh, anyone and everyone could raise money at ridiculous valuations. A, it was a founder's market. Founders were setting terms, things were going quickly. So everyone got good, used to those good times. And a lot of founders first company, they raised capital in those markets. But we're kind of going back to what it was like, 2016, 2017, where it's just only the best companies get funded. It's extremely difficult. You truly have to differentiate. You can't just be a Me Too product, like copying someone else's, product and saying you're different. Like you really need to have a 10x differentiation gap between you and your other competitors. Uh, VCs are under a much finer microscope when it comes to their investors, because of the high valuations over last year, overpaying for certain companies, losing money on deals. So VCs are a lot more hesitant. They're doing less deals. They're spending a lot more time into diligence. So you used to be able to go out in 2021 and raise a round in a month, like from start to finish, like money in the bank. Now it's like 3 to 6 months. And it's much more difficult. Hence, why we built Thunder. It helps streamline that process of identifying who's going to be investing in who and makes it a bit smoother. But even then, it's still a much more lengthy process than it used to be. And that's because LPs lost a lot of money. VC made some bad decisions. Founders overraised or underraised or, raised a too high valuation. They're doing what's known as a down round, having to do with those recaps that are extremely painful and depressing. We raised whatever $20 million on a $100 million valuation, but now you're only worth 30 million. Now it's like in this market, you might be cut in half or by 70% or 80% of whatever your last valuation was, because reality has kind of come back in and people are doing due diligence. There's no more free money. So it's a much more difficult market.
That definitely is kind of what I was observing in the public. So that makes sense that it's happening also in private markets. And I guess just last quick question, what do you see as the biggest trends that are and opportunities that are really shaping the industry today?
AI is everywhere right now. ChatGPT, OpenAI, everything they've done in the last, since they launched, I think in November, December. Basically, any money that's really being actively deployed by what I call more generalist VCs. So VCs have a lot more flexibility. They're not necessarily sector focused. They have a lot more flexibility in investments. A lot of that capital is going into AI related companies. That's kind of the hot trending uh, sector right now. Uh, Companies having to focus on profitability is a big trend. I've talked to a lot of companies, a lot of founders that raised a lot of money in 2020, 2021, and they're like, all right, let's come back to the market, get some more. And they come back and they're expecting these big valuations and lots of money, and it's crickets. And they're having to go like, wait, this wasn't a part of our plan. What do we do? Making layoffs. They're cutting their costs. They're focusing on driving more revenue. And the ones that can't do that, the ones that can't pivot or didn't reserve enough capital to enable that, uh, pretty much are going to, go out of business or get consolidated. And that's the other trend is I have a big bet right now on consolidation. There's a lot of amazing talent and technology out there that's raised hundreds of millions, if not billions of dollars across companies that is going to be underwater as far as the value of those companies. So there's like $1 billion companies that could probably get acquired for 50 million or 100 million. They've probably raised more than what they would get acquired for. And that's a reality. So companies that were smart, that were savvy, that were well capitalized, that are generating cash flow are going to come in and scoop up those technology companies as acqui-hires or asset purchases to acquire the technology, the IP, the team, pennies on the dollar, because pennies on the dollar is a better outcome for these companies than zero or facing debt or bankruptcy or anything like that. So these investors reluctantly will accept those terms because capital in the market for those businesses can survive. So people in investment banks and mergers and acquisition, M&A, corporate M&A, those people are going to be very busy over the next 2 years, in my opinion.
That was really great insights. I think that is all I had for you today. I still had more questions, but we went through so much. Before I let you go though, where can the listeners go to learn more about you, everything that you do in your business?
Yeah, sure. So anyone's welcome to reach out to me via email, Jason@Thunder.vc. If you want to learn about Thunder, it's just Thunder.vc is the website. And then if you follow me, I'm on Twitter at Jason Kirby, so JasonKirby, or LinkedIn, on LinkedIn/n/Jason R. Kirby. So anyone's welcome to follow me or reach out to me anytime.
Perfect. I will link those all in the show notes. Thank you so much for coming on again.
I appreciate it, Rebecca. Thanks for having me.
There's a lot of risk ahead because of valuations, because of the markets, because of what's happening behind the markets as well. But there's no guarantee about outcomes, good or bad. So that's why it's important, as we started out this conversation, that we understand what we own, we understand the valuations that we're paying for what we own, and we manage that risk over time.